Hello everybody, this is Philip Jonas at Kalamazoo Valley Community College presenting OpenStax Principles of Economics, and today we're covering sections 22.3 through 22.5, Indexation and Inflation over Time. In this module, you will learn how to adjust the dollar value using a price index, to explain the purpose and method of indexation, to identify costs of inflation, and to recognize key inflation episodes in recent history. Let's get started by talking a little bit about the federal minimum wage. So the federal minimum wage, which might be different from the minimum wage in the state you live in, was last increased in July of 2009. And as of February 2024, it continues to be $7.25, meaning it is not indexed to inflation. So we'll have a look at what that means in just a second. And of course, if you know a little bit about the minimum wage, you know that there are special rules for tipped employees, trainees, agricultural workers. Let's ignore all of that and let's just talk about the headline rate. So the dollar amount of the minimum wage hasn't changed in about 15 years. But what about its purchasing power? Can $7.25 today buy what they did 15 years ago? And for that, of course, we're going to look at our favorite price index for consumer expenditures, the CPIU. And we find that over that same time span, it has increased by almost 50%. So if we want to draw a good comparison of a number across time when adjusted for purchasing power, we really have to do some math to that minimum wage number. Here is a graph of the minimum wage in unadjusted terms for a little bit more than my lifetime. Again, if you don't know how to adjust for purchasing power, basically all you can say about the minimum wage is line has gone up, right? And in fact, if you have a look at this line, you'll notice that it looks different from other lines we've looked at in our course so far. And that's of course because the federal minimum wage goes up when a law is passed to increase it. That's why we've got these sort of mechanical looking edges here, because that's every time Congress decided to bump up the minimum wage. The minimum wage has of course been in existence since before 1978, but in 1978 the Fair Labor Standards Act really sort of spread it across workers in the way we think of the minimum wage today. So I think that's a nice period for comparison here. So let's get back to the idea of adjusting a dollar value across time. Basically, the idea is that if we want to compare dollar values while being sensible in terms of purchasing power, we really want to treat time and dollars like they are a combined unit of sorts. Like we want to draw a distinction between a 2009 dollar and a 2024 dollar because they couldn't buy the same amount of stuff. You'll also hear these time dollar units referred to as current dollars if you're referring to a dollar as it happened and its purchasing power at a past point in time. For example, again, a 2009 dollar could also be referred to as a then current dollar, as opposed to today's dollar, which of course means you are adjusting a dollar value to today's purchasing power. And really, that's the most common technique. While you can compare dollars by making them equal to any time period, as long as that time period is consistent, the most common method is to convert everything to be equivalent to today, because it's just intuitively most relatable. So let's have a look at the structure of the formula to do this, and then we'll just implement it a few times, and I think you'll find it's a very straightforward method. So basically what we're doing is we've got a dollar amount at a certain point in time, let's call that time 1, and we want to adjust it to a different point in time called time 2. So what you have to do is you have to grab yourself a sensible price index to change your dollar value, such as the consumer price index for what we're about to be doing. And then you multiply your original current dollar amount by the index value in the time period you want to go to, while dividing it by the index value of the time period you are coming from. So let's go ahead and implement that using the two minimum wage values we just talked about. So one more time, we've got two dollar values that are seemingly equal, $7.25. But in fact, they have two different units. The value from 2009 is in current dollars, so $2009. The value from 2024 is also in current dollars, $2024, but for the sake of our experiment here, let's call that today's dollars. So if we follow our standard technique, what we're going to do is leave today's dollar untouched, but we're going to take the old dollar and convert it into today's dollar. So we want to take those 2009 dollars, make them 2024 dollars. And in order to do that, we have to take our 2009 dollars, multiply them by an index from 2024, and divide by an index from 2009. If you're a little bit into unit conversions, you might even realize what we're doing here, right? The 2009 values will cancel each other out, that date will disappear, and our new result will be in terms of 2024. So we're going to use for our comparison here the Consumer Price Index in its modern form, the CPIU. As mentioned before, we've got values of about 215 back in 2009, about 308 today. So let's go ahead and plug them into our formula. Our index value today, about 308, 215 about back then, multiplied by the value from back then, $7.25. So that means we're going to take that $7.25 amount and increase it by a little over 40%. That's going to be our conversion factor here, giving us a result of $10.38. So the way you would read this is that the minimum wage in 2009 was $10.38 in today's dollars, or in 2024 dollars. Again, we're treating this as a unit conversion going from 2009 dollars to 2024 dollars. And now we can have ourselves a decent comparison. Let's go ahead and change our dollar values so that they are in the same time unit. And we discover the minimum wage from 2009 July no longer looks like the same number like the minimum wage today, does it? In fact, once we treat it in consistent dollar amounts, the minimum wage has fallen quite a bit. So of course, I'm using the minimum wage here as an example because it's a widely known number that it's really easy to do math with. This is not to suggest that you have to have any specific opinion about the minimum wage, like that we should increase it or whatever. In fact, you might think that having a minimum wage is a bad idea to begin with. That's okay. The point is, you have to learn how to adjust dollar values for time in order to make a sensible comparison to begin with. And in fact, to show that on a bigger scale, let's return to the graph I showed you at the beginning of the federal minimum wage since 1978. So that was in terms of current dollars at the time, nominal dollars, right? And all we saw was line goes up every time Congress passes a law. But now let's look at that same line and adjust every single month using this conversion technique to put it into January 2024 dollars. So let's have a look at our label here. We're taking the current dollar minimum wage, we are dividing it by the CPI value of the time, and then multiplying it by the CPI value of January 2024. And of course, you can see the picture radically changes. As opposed to the minimum wage starting at its lowest number in 1978, where in nominal terms it was the lowest number, and then rising to its highest number today, $7.25. In fact, the whole picture is inverted. Once we adjust it for purchasing power, across this time span, the minimum wage was at its highest in the 70s, equivalent to about $13 in today's money. And then as prices rise, as inflation takes its toll, every month you see the little notch, the minimum wage buys less and less. And then from time to time, Congress passes a law and bumps it back up so it regains some purchasing power, and inflation eats away, and it regains some purchasing power, and inflation eats away. But you can see the overall trend has been downward, and you could in fact say that since the modern implementation of the minimum wage, in inflation-adjusted terms, today it is at its lowest value it has ever been. That's the distinction between a nominal or current dollar value and a real or constant dollar or today's dollar value. So this is just the adjustment technique by itself. But of course, once you wrap your mind around how inflation affects the purchasing power of dollar amounts, you of course realize, hey, we don't always want that to happen. Might be a better idea to have an amount that's constant for purchasing power, even if its dollar value is changing. So that's basically the choice. You can write down a dollar amount and say, we're always going to have this dollar amount. But then, because of the effect of inflation, whatever you've written down, it might be a price, a wage, an interest rate, is in fact changing value on you in purchasing power terms. Or, alternative, you can employ a very useful technique called indexation, where you write down an initial amount, but then by law or contract, you say this amount will automatically be adjusted for the effect of inflation, with the idea being that the dollar or percentage amount might change, but in the process, the purchasing power stays constant. And this shows up all over our society. And I'm going to start out with just 3 examples to show you how it works that I think are particularly fascinating and big in our society, and maybe will give you a little benefit in your personal life as well. One of them is our big public pension system, the Social Security system, which, among other things, features a cost of living adjustment, a so-called COLA. And 2 other ones are from the world of saving your money. They are both about bonds issued by the federal government. One important category referred to as Treasury Inflation Protected Securities, or TIPS for short, and the other one, savings bonds, Series I to be specific, sometimes I bonds for short. So let me show you what these indexation techniques are about, and in the process learn how you implement indexation in general. Because after we're done with this module, if you ever find yourself in a position to write a law or a contract that lasts for some years, and you have a dollar amount in there, which that's likely to happen, right? I want you to ask yourself, do I actually want that dollar amount to be constant? Or would it be more sensible to index it because it's the purchasing power I care about? So let's start with the big one. A huge component of our federal government, and perhaps our intergenerational social economic contract, if you want to call it that, is what we like to call Social Security. Or to be a little bit more specific, the Old Age, Survivor, and Disability Insurance, OASDI, to be technical about it. This is the largest US public pension system. It's not the only one. A railroad has one, military has one, but this is the big one, right? Almost everybody finds themselves in the Social Security system. And it's a system where on one side, money goes in, not out of the general budget, but sort of in a very dedicated way through a so-called payroll tax. So that's a tax on wages, on so-called covered wages. Again, not everybody is in Social Security, but almost, right? And the current rate for that is 12.4% of wages go into the system. That tax is referred to either as a Self-Employment Contribution Act. If you are like 1099 independent contractor or something like that, you'll see the whole 12.4% come out of your income into the system. Or if you're a more ordinary W-2 style wage employee, you'll only see half of that, 6.2%, come out of your paycheck, but your employer is also kicking in 6.2%. So it's the same overall percentage, and then it's the Federal Insurance Contribution Act. So on your pay stub, you might see that acronym FICA show up there. So it's 12.4% flat, but only up to a maximum. A very high maximum. In 2024, that maximum is $168,600 per year. But if you manage to earn more than that, starting with $168,601, you will no longer be paying taxes into your Social Security system. So like those first $169,000 there, always taxed for everybody that's got covered wages, but beyond that, 0% tax. Is that a sensible setup? That's a whole different question. We're not getting into that. So on the one hand, we've got the money going in. And on the other hand, it's going back out to people who are currently old age. So that's the legal definition for sort of the ordinary way in which you draw Social Security, the most common way you reach retirement age, but also to some classes of survivors, of people that have reached retirement age, or some situations with minors as well. We won't get into all of the specifics. Or even before you reach retirement age, if you've already earned enough credits and become disabled, you can get that Social Security even earlier. And there's always a little bit of confusion there with the disability, because there's in fact a second disability system that we're mostly going to ignore. It's called SSI, Supplemental Security Income. So like, doesn't stand for Social Security, Supplemental Security Income, which confusingly is also administered by the Social Security Administration. But that's a thing that's just funded out of general federal taxes. It's not directly part of this payroll taxes in, and then OASDI benefits going back out to the other side. So Social Security, of course, by definition, is a system over time, right? You're sort of contributing taxes for the duration of your wage earning years. And then, hopefully nothing goes wrong. You make it to old age, and then you start drawing benefits. And that has a lot of implications for how you want to set up such a system with respect to the effects of inflation. And considering that the system is almost 100 years old, it's actually set up with a number of sensible indexation rules. So first of all, that cap on taxes, only the first $169,000 are taxed, whether it's sensible or not. That cap does go up every year with an index. It's an index we're not going to talk anywhere else about in this course. It's called the average wage index. So it doesn't go up with the inflation rates, but actually with how much wages are increasing. And over very long time periods, wages, of course, are increasing a little bit more than inflation as our country is getting richer. And then the benefit you receive in retirement is computed in part based on your earnings during the years where you were paying in. Specifically, Social Security looks at the 35 years where you had the highest covered wages. But of course, if some of those earnings were like 30 years ago, they're very small compared to today's values because of the effect of inflation. So again, before picking the 35 highest years, those get increased using the average wage index, using that exact same adjust for time calculation we just practiced on the minimum wage. Now, for those of you that are real Social Security fans, there's some finer details there, like the earnings get actually increased not to your retirement year, but to a couple years earlier. But then the earnings you have after that certain point get counted at their current values. They don't get backwards indexed. We're going to ignore those finer points and just look at the big picture of how the indexation works. And then finally, that, overall amount of indexed earnings gets converted into the so-called primary insurance amount. And there's a bit of a progressive formula to that. So if your earnings were a little bit lower, you get a higher percentage of them in retirement. And if they're a little bit higher, that percentage drops off. So it's supposed to be a little ability to pay justice that's built into there. And once again, if you've got a progressive system like the federal income tax system, for example, that means you have to decide on the bend points, like where do we cut into different percentages. Those bend points are indexed using the average wage index. Okay, so now you've got your primary insurance amount, and that gets converted into a monthly benefit. And you might think to yourself, okay, we're done indexing now, right? Still not done. Because if we calculated a monthly benefit for you, and then we just kept that benefit for the rest of your life, you might be living for decades more. Once again, that constant dollar amount would just be losing purchasing power month after month. Can't have that, right? So every year, we're going to then increase how much you receive as your Social Security benefit by indexing it to the CPI. But because Social Security is such an old system, this is a slightly older flavor of the CPI that's been around for longer, the so-called CPIW. Very similar to the CPIU. We're not even gonna get into how different we have to worry about this thing being. So let's do a little example of what we're talking about here. And we're going to start with a very sort of exciting, strong example. Let's say you've been working since you're 22 years old and you're retiring at age 62. So 40 years of working, but not just any kind of working. Since you were 22, you exceeded that maximum covered amount in Social Security, that cap. So you've just been pulling in the big bucks your entire life, and you're about to earn the highest possible amount of Social Security you can. It just makes the math easier for the example. So if you are such a person that's worked for 40 years at more than the maximum covered amount, and you're retiring at age 62 in the year 2023, after picking your 35 highest years of earnings using that indexing method with the average wage index, which we're not going to do because we don't cover the average wage index, your indexed monthly earnings would be a little over $12,000 a month. So basically, this is saying, on average, for your 35 best years, you were pulling in a little over $12,000 a month after you've adjusted the old dollar values to be equivalent to today's wages. And then I want to show you the formula that gets used to convert your lifetime average earnings into your so-called primary insurance amount. So what happens is Social Security has two bend points in its calculation of your primary insurance amount, giving you three total percentages. For the first, these are 2023 numbers, because that's when our example worker is going to retire. For the first $1,115 that you earned in your lifetime, you're going to get a 90% pension, if you will. Like 90% of your average monthly earnings will continue being paid out by Social Security. So everybody gets that for the first $1,115. And then for the dollars in excess of that, up to about $6,700 per month, you receive a much lower amount, 32% of whatever indexed monthly earnings fall into that range. And then finally, anything that goes over the top bend point, so here we're starting to make really good money, right? You get only 15% of those dollars paid out as your pension. So for example, here we've got the worst or best case scenario for a worker. So best case scenario in the sense that this person made the most money possible for Social Security purposes and will therefore receive the highest possible Social Security amount for their retirement age, because we take $12,000 and attach these various percentages here. It actually converts into a primary insurance amount that's a little bit more than a quarter of those monthly earnings, right? Because only part of this, the worker gets 90%, then another chunk, they get 32%, and anything beyond 6,700 here, so that's almost half of their earnings, they're only going to get a 15% multiplier. So it reduces down into this $3,700 number here, the so-called primary insurance amount. And that's what you get if you retire at your so-called full retirement age, which, if you're listening to this video right now, that's probably age 67, maybe a little younger if you're a little on the older side, or maybe you watch this video 10 years from now and they'll have bumped up the full retirement age by then from 67 to an even higher number, right? But right now it's 2024, and at least for me, full retirement age still 67. So I'm counting on you, federal government there, right? So if you want to take it earlier than your full retirement age, that's going to get you hit with a reduction. So for our worker right here, they're going to take it the earliest they can, age 62, and that means about 30% reduction on their monthly benefit. So they're going to receive about $2,600 a month for the rest of their life. And then, which is the part we actually want to get to, we're going to increase that monthly benefit for them once a year to keep up with consumer prices. So let's get to that step, and I hope you didn't mind or maybe even enjoyed a basic explanation of how your Social Security benefits will be calculated one day. Assuming the system still exists in this form, which is always a big question when you're thinking decades into the future. So here's our worker earning the maximum Social Security benefit of $2,572. There they are again. And now they've been retired for a year, it's 2024, and they are about to receive an increase in January. So this is going to be indexed to the CPIW. If you want to be really technical about it, there are specific months of the CPIW that Social Security here uses. Don't worry about it. Like they used July, August, September of the previous year and the year before that, but I've got the numbers covered for you. So for our hypothetical Social Security recipient here, the relevant CPI number has increased from about 292 to about 301. So what does that mean for their monthly benefits starting in 2024? Well, it's the same indexing formula that we used to already look at how the minimum wage behaved over time. Only this time it's being used to keep the purchasing power constant, right? Same formula, different use case. So we're going to take that benefit in the time period we're coming from, 2023. And we want to convert it into a 2024 benefit. So that means we're going to have to multiply by the index in 2024, divide by the index in 2023. The 2023s will cancel and we'll be left with a 2024 benefit. Let's go ahead and plug in some numbers. We've got our beneficiary receiving $2,572 with a new CPI coming on at about 301, old CPI about 292. So that's going to be a slight bump up, about 3%, a little bit more than 3%, and bam, there it is. Starting in 2024, our recipient now gets $2,654 per month. And that adjustment is going to happen year after year. In fact, when it comes to questions of future funding for our Social Security system, one thing I want you to keep an eye on is that almost certainly there will be a discussion about this adjustment right here, bumping up the benefit year after year. Because one way in which you can cut Social Security benefits if you want to make the system less expensive is that you can make this amount increase more slowly. So you could make an argument here, hey, CPIW is a pretty old number. Nowadays, we've got that chained CPIU, which increases a little more slowly because it allows for consumer substitution. That'd be a way to decrease Social Security benefits. Then, of course, if you're opposed to that, you might say, yes, but that represents the index for an average American household. Is that representative for the consumer expenditures of people in old age? Maybe we should be using the CPIE, which is a separate CPI for elderly people. And back and forth we go. Another obvious way, of course, of cutting benefits would be you raise that retirement age, right? Then people have to draw it later. Or if they draw it as early as 62, they'd have a bigger deduction. This worker had about a 30% deduction. If you bump that retirement age to a later number, every month you take early reduces by a certain percentage, so you'd be looking for the same retirement age again at a lower benefit. But hey, those are exciting political questions for down the line. Today we're just here to learn about indexation and the effect of inflation. So once again, it's basically always the same formula, whether we're adjusting a dollar value for time or indexing one automatically. Now finally, before we let Social Security go, I just did a math example, because it's easiest, for a person receiving the maximum Social Security benefit. That's, of course, not representative of the typical person receiving it. So let's just have a brief look here at quick facts Social Security from January 2024. First of all, realize the size of the system. When we look at old age, survivor, and disability recipients, we've got a big 67,000 number here for recipients, for beneficiaries, but that's of course in thousands. So in fact, over 67 million people are Social Security beneficiaries. If you think about the size of our population, that's a pretty big chunk of the population, right? Roughly a fifth of our population. So we go over to the average monthly benefit of our actual population. It's much lower. The typical Social Security recipient receives about $1,800 a month. And we could now break that out a little bit and say, okay, but how representative is that? When I'm thinking about my own retirement, do I maybe just want to focus on what's the typical person in retirement drawing? Okay, so here we've got the retired workers. That's the biggest chunk of our beneficiaries, of course, over 50 million retired workers. And they're the average monthly benefits, about $1,900. Okay, bigger number because other classes of beneficiaries, such as, for example, benefits to spouses or children, that's a percentage, or disability workers, they probably haven't accumulated as much of an insurance amount yet. It's going to be lower. So the average for actual regular old age retirees, the highest average in this table. But I still got to ask you, you do you. Think about that for a second. Living for the rest of your life on $1,900 a month, even if that gets adjusted for inflation year after year, is that the lifestyle you're looking for? Because that's it. That's all you're going to get out of the Social Security system as an average person. Again, absolute maximum if you are making the equivalent of like $170,000 today for the rest of your life, then maxing out, in the high 2000s per month. If you want to do better than that, I really recommend you save some of your own money as well. Because if anything, I wouldn't be surprised if these benefits are going to go down a little bit in the future in order to help with the funding for the system. All right, so this is Social Security. We're now done with Social Security. I just want to mention one more time, it often gets confused with that other system of disability benefits we've got at the federal level, the so-called SSI system. So when you hear about people getting that SSI, please don't get the impression that this is the same as disabled workers who are drawing regular Social Security disability benefits. So those, you see here average amount like over $1,500 a month. But if we look at the SSI system, So that's a secondary disability system we have for people who never even reached sufficient Social Security credits. And you can only get this if you're disabled and you've got very low net worth, very, very low income, quite possibly no income. You'll see those benefits are considerably lower. Like your typical disability recipient in SSI terms, we're talking about $700 a month. They are living on, assuming they are not in a position to earn additional wages on top of that. So that can be a really tough situation. Okay, so that's Social Security for us. Let's move on to another fun example, Treasury inflation protected securities. So as you probably know, the US federal government often, like right now, spends more money than it takes in taxes. How does it do that? By taking on debt. But taking on debt, the actual mechanics of this, if you are a government or if you are a big corporation, often takes the form of selling so-called bonds, which are basically, if you're unfamiliar with those, certificates that promise a repayment in the future. And if you aren't familiar with them, you probably should get familiar with them because when it comes to saving for that retirement, want a little bit more than Social Security, it is likely that you'll want to use a mix of stocks and bonds for your retirement savings. So you have to at least understand the basics of how each of these work. So if we look at bonds in general, they pay interest based on a certain percentage rate. This is sometimes referred to as the coupon rate of a bond, because back in the days, bonds were a piece of paper, and for the interest payments, they had literal coupons on the side, and you cut them off with your scissors, and you take them into the bank, and you get your interest payment. And then at the end of the bond's lifetime, almost all bonds are, somebody borrowing money for a finite amount of time, although perpetual bonds do exist. You get back the amount of money that's referred to as the par value of a bond, or sometimes the face value, because again, back when these things were big pieces of paper, you had the coupons on the side for the cutting, and then the big piece in the middle would say in a big number how much you would get at maturity of this bond. Now, we're going to ignore, to make our life a little bit easier, that when you initially buy a bond, so when the federal government is first borrowing this money from you, you might be paying more or less than the par value for it. You might give the government more or less than $100 for a $100 bond. That's referred to as buying it at a discount or a premium. And then if you use a net present value formula, you can learn about that in finite math or your finance class. It affects the implied interest rate of that bond. But we're going to keep life really simple here and say, hey, you're going to buy a $100 bond for $100. So at the end of the bond, you're normally going to get back $100 and, you're going to get some interest payments along the line. I say normally you'll get back $100 because there is a special class of bond that the federal government issues referred to as TIPS, the inflation protected securities. And what makes them inflation protected is that the par value of that bond, the number printed on the face of it, if it were a physical piece of paper, is adjusted to increase or decrease with the consumer price index. Technically, the not seasonally adjusted version of the consumer price index, which is not the version we normally talk about here in this course, but close enough for our purposes. So let's have a look at how this is a way to index a financial instrument. So here we've got ourselves a 10-year TIPS. It was bought in January 2023. That means in January 2033, you get back the face value. Only that face value is going to get adjusted. Also, looking up the actual 10-year TIPS that was sold on January 15, 2023, it had a coupon rate of 1 1/8 or 1.125%, because let's not quote percentages in eighth, because what year is it, right? This coupon rate in the first year might pay out based on that face value or really close to it, depending on some technical details. But then the par value actually gets adjusted year after year. How? Using our old favorite, the indexing formula, the adjusting formula, right? So again, there are some very specific details about what time period gets used for the CPIU when adjusting it. And actually, because the CPIU comes out once a month and these things might pay out interest on a different day of the month, it gets like interpolated in between those. Now we're going to skip over all the financial details. Future finance nerds, get into it. I'm sure you'll have a good time with it. I'll just give you some numbers and say these are accurate and it'll be close enough for our purposes. So in 2023, we've got our CPIU at 299. In 2024, we have it at 308, which once again, of course, means we're looking at like roughly almost 3% increase here. Not quite the same increase we saw a minute ago because this is not seasonally adjusted. Don't worry about it. But what we want to look at is how the par value of this bond adjusts. So as always, we take our 2023 number, multiply it by the 2024 index, divide by the 2023 index, and our result is that the par value bumped up to 103.09. So actually a little bit more than 3%. And now this coupon here, 1.125%, no longer gets paid off the original $100. In that first year, that was $1.13. Now it gets paid off the slightly higher amount. So we take $103.09 and multiply it by 1.125%. And we end up with an interest payment in 2024 of $1.16. Woo! Interest is keeping up with our rate of inflation because the par value is keeping up with the rate of inflation. So this is one way in which you can set up indexing a financial instrument. You can say sort of the par value, the base value that we're talking about, we're going to bump that up, but the interest rate stays at the same percentage. You can achieve a very similar effect by saying, hey, instead, we're going to adjust that percentage that gets paid. And our example for that will be Series I savings bonds. So those are another way that the US government borrows money, but really to a big extent, this is just also a way that it provides a benefit to its residents by giving them a safe place to park their money. So these bonds, yes, they are bonds, but like not really, because they're so-called non-marketable bonds. You can't buy or sell them to anybody else. You give money to the US government. There are certain terms. It accumulates. You can get it back from the US government. It's almost more like a savings account. All right, so there are different savings bonds that exist. You might even have received one as a gift at some point in your life, but the one we're going to be talking about is the Series I savings bond, sometimes referred to as I bonds, which is the one that is adjusted for inflation. So what the I bond does is, when you buy it, it states an interest rate. But that stated interest rate, currently a little over 1%, is just part of the interest. It's a part that's guaranteed for the next 30 years. And then in addition to that fixed part, you also get whatever the current rate of inflation is. And whatever this combined rate is, it gets added to the principal of the bond every 6 months. So it doesn't get paid out as an interest payment like a regular treasury bond would, but instead it goes into the principal amount. Again, the thing almost acts more like a savings account. Now, the formula to combine the fixed rate plus the rate of inflation, it's a little bit complicated because we're like compounding 2% increases, and we're not going to use the real formula that gets used for real Series I bonds. Instead, I'm going to use this opportunity to introduce you to a shortcut formula for combining interest rates or other rates of return and inflation rates called the Fisher equation. after a famous economist from about 100 years ago called Irving Fisher. So if you do a little bit of math, and if you can do logarithms, you can actually prove to yourself why this is approximately true. You can show that if you want to combine a real rate of return with a rate of inflation into a nominal rate of return, meaning in other words, a rate of return computed using constant dollars into a rate of return computed using current dollars, all you have to do is add the rate of inflation to that real rate of return. A massive shortcut. Is it exactly right? Nope, slightly off. It's off by the product of the real rate and the rate of inflation. But as long as you've got two percentages you're multiplying that are both kind of small, that's a very small product. Like, for example, for the Series I bond example I'm about to take you through, we will do it using the Fisher equation, which is, I will just do it now, of course. And as opposed to the real world results, our numbers will be 0.02% lower than the real deal. So close enough. And it's a much easier formula. So let's do a semi-real example. While I bonds currently have a fixed rate of a little over 1%, we're going to go a little back in time to May of 2023, when I bonds were issued with a fixed rate of 0.9%. So again, that's only half, if you will, of the combined rate you would be paid. In addition to that, the United States Treasury establishes the rate of inflation for that time period. They always do May to November and then November to May. And for that time period, they established a rate of inflation of 3.38%, which of course is backwards looking, because when you buy a bond in May 2023, they don't quite know what the future is going to hold yet, right? And then going forward to November 2023, this should of course say 2023, because it is not yet November 2024. Sorry about that. Starting in November, they update that rate and say, hey, now the rate is going to be the combination of that fixed rate that doesn't change and an inflation rate of 3.94%. So how do you figure out the new combined rate, the actual interest the bond pays you? Well, using the Fisher equation, your life here is super duper simple. Just add them up. If you want to combine a real rate, and that's what the fixed rate is, it's effectively a real rate because you get it on top of inflation, and a rate of inflation into a nominal rate that tells you how many dollars you're getting paid, just add the numbers up, right? So we add the numbers together and we find our interest rate that the bond pays increases from 4.28% to 4.84% because the rate of inflation had bumped up a little bit. There we go. That's it. That's how you can also adjust for inflation. You can say, hey, if we've got an interest rate on our instrument, whatever that interest rate is, let us add a current rate of inflation to it. Second way, first way we discussed, instead you just have some sort of fixed rate, but you make the value of the instrument that pays out the interest go up with the rate of inflation. All right, so those were three fun examples of how you can index dollar values or even percentages to automatically keep up with the rate of inflation. So why is inflation a problem? Well, the problem is not all of life is indexed. Like, actually, quite a bit of life is indexed once you learn about indexes. Social Security is indexed, large parts of our tax system are indexed, all sorts of indexations happen, but not all of life is indexed. And that means inflation can really distort economic life and give us bad outcomes anytime one of two things happen. Number one, when inflation is just a high number, it starts to sort of produce nasty effects. So what I mean by a high number here is, yes, on some level it might seem nice to have zero inflation, just constant, but it turns out deflation is pretty bad for economies. So we actually like to have a little bit of positive inflation. Current US inflation target, 2% per year. And I wouldn't call that high inflation. even like if we don't hit the target, if we're at 4 or 5%, okay, I don't like that. We're exceeding the target. We should get back to the target. But I wouldn't say it's like really big yet where it gives us the problems I'm about to tell you about. But there are also time periods, and I'll show you those at the end of this module, where inflation is considerably higher than single digits. And that's going to be a problem. And then second flavor of problem, sort of, it seems similar at first, but it's actually a slightly different problem, is when inflation is unexpectedly different. And that's a problem because anytime you make an arrangement that covers a lot of time, if it's not an indexed arrangement, you're sort of implicitly saying, hey, we are making an assumption about future inflation here. And if inflation doesn't end up matching that assumption, if it's higher or lower, either way, all of a sudden you've changed the arrangement in some potentially very unpredictable ways. Okay, so let's go through the problems here, and we'll start with a classic. This isn't the biggest problem when it comes to inflation, but hey, it can be nasty, and it starts to give you a flavor of how a seemingly, neutral thing like inflation, hey, all the numbers just get a little bit bigger, actually can have real consequences. And here our first classic is what's referred to as menu cost in economics. So that's sort of a metaphor, right? Like if you're running a restaurant and you want to change prices in your restaurant, you might have to print new menus, and printing new menus costs actual economic resources. So when we talk about menu cost, we simply mean there is a cost associated with changing prices. And the higher inflation is, because it's a rate of change, the more often you have to change prices. And not all prices are easily indexed in a way that people will accept. So for example, think about going to the grocery store. They've got prices on all the shelves, right? Sometimes even prices on the products themselves. And at our current low rates of inflation, no problem. They have to update those from time to time, but that's fine. That's part of the cost of doing business. But if you are living in a situation where inflation is quite high, and I'm going to show you some graphs in a minute, but like, for example, imagine inflation is like 100%, like prices double every year. That means if you're running a grocery store, you probably have to adjust prices in your store like every day, maybe every 2 or 3 days. And now all of a sudden you've got like these actual economic costs you're bearing of, you're gonna have somebody on your payroll full time who's just there running through your store all day, changing all the price signs. That's a menu cost. And menu cost, yes, that can be directly the cost of changing a price. It can also be a little bit indirect. If for some reason a price stays fixed, sometimes that happens. I'll give you a silly example, like the point of a dollar store is that the price is $1, right? Then if you want to react to inflation, you have to change the quantity of the item instead, right? So you've got like a box of forks for $1 in the dollar store, and there's like 12 forks in there. And now inflation hits and you want to put 10 forks into every box. Oh, that has mind-boggling implications for all the things that have to happen along your supply chain so that you now have 10 count boxes in your store. And if you put that together, that changing prices itself can be costly, at least for some businesses. It can also give you this odd effect where prices will only be changed sometimes because it's expensive, but it's going to be a big jump anytime it happens to make up for the inflation. So then people will start like gaming the system around these big jumps. You want to like do your purchases right before the big jump and then hold off for a while after the big jump is over. Very different from a price that'll change very frequently. Like think of the price of gasoline. That's super easy to change, so it'll just easily keep up with inflation, right? So all of a sudden you'll have these strategies. Oh, Mondays I buy my gas because Mondays is when the stores raise prices, right? And then Sundays I go to the store because that's right before they implement their big price jumps. That's menu costs. And it's a first flavor of how inflation is a problem, but it's not even the big stuff yet, right? So let's get into even bigger problems. Sticky wages. So long term, wages are like any other price. They are the price of labor. Long-term wages sort of incorporate inflation into how they are set. But that's sometimes a little bit hard to believe, for good reason, because short-term wages are one of the slowest moving prices in our economy. They are what we refer to as sticky. We already talked about this in the module for unemployment. But basically what that means is if inflation speeds up, even if wages catch up eventually, for a while they lag behind. And that's not good news for our economy. I mean, it's not good news for the workers, right? Like, obviously, their real wages are declining, their purchasing power is down. But it also means because the real wage is now not representing a proper equilibrium in the labor market, companies will find that they have difficulty hiring workers. There will be worker shortages. And that's already bad. But actually, special danger, this is a major reason why economies have such a hard time digesting deflation. During deflation, because wages are just super sticky downward, it's very difficult to get wages to fall. During deflation, as prices fall but wages tend to stay constant, so real wages go up, we then end up with large unemployment. And you can just see that if you look at deflation episodes and unemployment episodes in the United States. They go hand in hand. They go hand in hand. All right, that's number 2. And it gets worse. Well, worse than sticky wages, I'm not sure, but another bad one. Wealth redistribution. I already mentioned this. When inflation changes unexpectedly, it can retroactively change deals in ways that you're not always gonna expect. Basically, anytime you make a deal that contains a dollar amount or an interest rate, and the deal lasts for a couple of years, you want to think about, do I actually want to write the dollar amount or interest rate to be constant in that contract or law? Or do I want to index that to inflation? But not all of life is indexed. So we have all these long-term deals in our economy that are for specific nominal numbers. And now, this nominal number, it effectively baked in had an expectation for the rate of inflation. If inflation, actual number now, is different from that expectation, we have changed the real terms of that deal. And once again, we're going to rely on our super easy Fisher equation to make that point. Here I've slightly rearranged it, but still the same equation. So if you want to look at the real rate of return in a deal, slight simplification, you can take the nominal, the dollar rate of return of the deal and just subtract the rate of inflation. And let me use that to illustrate a thing or two. So for our example here, we are going to look at a 30-year fixed mortgage, just a staple of the American economy. And think about what a marvel it is. Here you're taking a loan, a huge loan, largest purchase most of us will make in our lifetime. And you're getting it at an interest rate where the bank is saying, we're going to keep that rate fixed for the duration of those 30 years. So it's not indexed to inflation. It's a fixed nominal rate on that piece of paper. It's hard to believe that such a thing even exists. So for our baseline here, we'll say the bank gave you a mortgage with a 5% interest rate. And let's say in the background, the bank and you, that meant you were expecting a 3% rate of inflation. So if we employ our Fisher equation then, what that means is 5% interest rate nominal minus 3% expected inflation. The bank and you were both expecting that in inflation adjusted terms, you would be paying 2% return on that mortgage. That was like your real cost of credit. The rest of interest just gets eaten up by inflation. But now, what if something unexpected happens? So let's, for example, say that we don't have inflation, we have deflation, 1%. So the inflation rate is negative 1%. Okay, look what happens here to our formula. We've got a 5% interest rate and we're subtracting negative 1% inflation. Subtracting a negative, we're adding 1%, right? The real return on this mortgage, or the real cost of the mortgage from your perspective as the borrower, is now 6%. 3 times as large as what was originally agreed, expected. When this unexpected deflation hits, borrowers start going bankrupt because the cost of servicing the loan is way up in real terms. So during the Great Depression 100 years ago, this was famously a problem with farmers. They had these mortgages on the farms with a fixed nominal interest rate. Deflation hit, so the agricultural output, it would sell for less year after year. Corn prices down, wheat prices down, but their payment was fixed in dollar terms. So more and more farmers couldn't afford the payments. Wealth redistribution from the farmer to the bank. Or the other way around, if inflation is unexpectedly high. So like you agree to the 5% interest rate, great. And then unexpectedly inflation is actually 6%. So 5% nominal rate of return, subtract 6%. Real return is now negative 1%. In real terms, the bank is paying you to borrow money. That is not a good model for running a credit business. And now the lender is in trouble. Again, just to make clear like how this puts the lender in trouble. What's going on is the money that the bank is lending you, the bank's not getting that for free. It's attracting it in the form of deposits like savings accounts and such. And inflation is 6%, they have to pay way more out on those savings accounts. And all of a sudden, like what you're paying on your mortgage isn't enough to pay out the interest on those savings accounts, and the bank's just losing money month after month. And it's because inflation, it's not just is it higher or lower, is it different from what was expected. We have changed the deal retroactively, at least in real terms, and that's bad news. And it's really bad news if inflation isn't reliable, because then people can't even make a 30-year fixed deal to begin with, because nobody can be certain about what's actually going to happen. So I say we want inflation to be low, like our current official target is 2% inflation. Sure, that's true. But what's way more important than like, is our target 2%, 3%, or 4%? What's way more important is how credibly committed are we to keeping the target at the same number? Because we might have deals that last 30 years built on the back of this. And if we get a reputation for, we like to change our inflation target from time to time, you're not going to be able to get a 30-year mortgage anymore, at least not with a fixed interest rate, which will make affording that house way harder. Okay, let's get to the last one. It's maybe not the worst one, but it's sort of the most mathematically complicated one, so I wanted to build up to it. Tax distortions. Inflation can distort how the tax code works. Now, I don't want to overblow this. Very often, this is not a problem. So number one, you've got many taxes that are a flat percentage amount. And there, if inflation makes the dollar values bigger, doesn't matter. Still the same percentage gets taken out, like the sales tax, for example. Or like that Social Security tax, number one is a flat amount for most people. You have to earn a lot of money before you get into the tax-free portion of it. But secondly, we do actually index where the tax-free cutoff is. So it's just, inflation is not a problem there. Even with taxes that aren't flat, like look at the federal income tax, right? It's not flat. If you earn more money, you actually start paying higher percentages on larger dollar amounts, a so-called progressive tax system. But those cutoffs, those bend points, just like the bend points in the Social Security system. Social Security is such a good example for so many things. Those bend points increase every year automatically with the consumer price index. So again, like we've got the distortion already taken out of it. But even with those major tax systems being more or less tax distortion free, unless you want to really argue about whether the index we're using is sensible, that gets into the weeds. We do have a couple of areas where inflation actually makes a difference. And one of them is, what if you are paying taxes on the change of an asset price? So classic example here. For many people, the current so-called capital gains tax rate is 15%. So that basically means you buy a stock, you sell the stock a while later, you sell it for a higher amount than you bought it for. Yay, you made some money. You gotta pay taxes on that money. Again, 15%, very common rate right now. But the money you're paying taxes on is the increase in the dollar value of the stock. There's no adjustment for the effect of inflation, and that has an interesting impact. Because inflation raises all the prices in your economy, including the prices of your stocks. And we're going to illustrate that using, once again, the simplification of our Fisher equation. So let's say you buy a stock for $100. And the company actually makes an economic return as well. They earn 4% inflation adjusted return. They don't pay it out as a dividend. They retain those earnings. So assuming an efficient market, that's going to be reflected in the price of the stock. So in one world, let's say inflation is on target at 2%. So using our Fisher equation, if we've got a $100 asset that's earning 4% real and there's 2% inflation, we can just add those up. That asset's going to have a nominal, a dollar return of 6%. So when you sell that stock, it's going to have risen in value $6. 4% from actual economic returns, 2% from inflation. So now you're paying taxes on the gain. Let's calculate the gain. You bought it for 100, you sold it for 106, that's $6 of gain. So $6 of gain at a 15-cent tax per dollar, that's 90 cents of taxes. So you don't get to keep the whole $6 of gain, you get to keep $5.10. Still with me? A lot of numbers, right? Stock went from 100 to 106, 90 cents went to the government, $5.10 go into your pocket. So on a nominal basis, on a dollar basis, your after-tax return is 5.1%, $5.10 on a $100 investment. But using your Fisher equation, you can convert that into a real after-tax rate of return, subtract 2% back out for inflation, real after-tax rate of return 3.1%. So you can already see that there's something weird going on here, right? Like the actual sort of base level real return of the stock was 4%. And okay, you're paying 15% capital gains, but you're not just paying 15% on that 4% return, right? It's not just falling to 3.4% real return. You're paying 15% on both the real and the nominal return, making your real return even lower. But where you can really illustrate where this does something a little bit weird with the tax system is, let's play this again with a higher inflation rate. So we've got our stock, we're buying it for $100, it earns 4% real return, but it's in a world where inflation is above target. Inflation is currently at 6%. So using our Fisher equation, that means the value of that stock is going to increase 10%. 4% real plus 6% inflation. You're selling the stock for $110. So you've got $10 gain on paper that you're reporting to the IRS. You have to pay 15% tax on $10. That's $1.50 in tax, or in other words, you get to keep $8.50 of your return. Okay, let's go through it one more time. $100 asset price goes up 4% real plus 6% inflation, $10. Off that $10 gain, you got to pay 15% to the government, so you get to keep $8.50. So again, on a dollar basis, you could now say your after-tax return is 8.5%, $8.50 on a $100 asset. But of course, in real terms, you want to subtract out the rate of inflation. Fisher equation, 8.5%, subtract 6%, your real rate of return is 2.5%. So what's going on here? We have two worlds where the same stock is earning 4% actual economic return. But how much of that you get to keep in your pocket depends on the rate of inflation. If inflation is rather low, it generates less sort of phantom gains that get taxed. So what you get to keep in real terms is a little bit closer to the actual raw real return of the stock. If on the other hand, inflation is a little bit higher, 6%, you've got a bigger chunk of sort of a phantom gain here that you have to pay tax on, which means in real terms, you get to keep less of that 4%. Now, I'm not exactly concerned that capital gain taxation effects, are going to be the end of our economy, but it is sort of the mathematically most challenging version of how inflation, when it's higher, all of a sudden changes how aspects of our economy work that aren't designed to handle changes in inflation, or at least aren't explicitly designed to compensate for it. Then there's one more little weird tax distortion that shows up with inflation. We're not going to do the math here. The math gets too complicated, and this is really more for the fun of it, how else inflation can have an impact, but it can explain something potentially very serious. So for our economy, fortunately, this is a little bit more for the fun of it. Inflation also directly generates tax revenue. Yeah, when inflation is higher, that inflation itself is a tax. Not in the sense of sticky wages, that your wages aren't keeping up. That's not what I'm talking about. Inflation directly generates revenue for whoever is creating the money in the economy to begin with. So we'll talk about that in a future module, that in modern economies, money is created from something called a central bank. Don't worry about it for now. If you want to think back to ancient times, imagine we were using gold for money. Like, who creates the money in that system? Somebody who's mining gold out of the ground. Well, whoever creates money is actually directly making money from that creation of the money. Like, mining gold out of the ground actually puts money in your pocket, like literal pieces of gold. Likewise, the central bank creating units of money puts money into their pocket, which, nowadays they just rebate back to the government. And the way it does that is that by adding money to the system, it's making anybody else's money worth a little bit less. That's what inflation is. So really, inflation is also directly a tax of real economic resources from anybody who's holding wealth in the form of actual money balances, like cash in hand or a checking account or something like that. It's basically making that purchasing power shrink a little bit, and in exchange, putting some purchasing power into the hands of the institution that created the money. Now, at low levels of inflation, like we enjoy in our country, that's a very insignificant amount of money compared to the size of the federal government. So, don't worry about it. It's a neat effect you can talk about, right? Seigniorage is the technical term if you ever want to look it up. But it can explain why, if you have a country with poor governance when it comes to its money supply, you can end up with high rates of inflation. Because basically there's this temptation of collecting taxes without directly letting on that you're collecting taxes. You're doing it indirectly by increasing the money supply, thereby giving your government more purchasing power, reducing everybody else's money holdings purchasing power, and again, bam, the price of this higher inflation for your economy. And if it gets really out of hand, we might even refer to this phenomenon as hyperinflation. But what does that look like? Well, now that we've discussed all the technical details, let's just finish up by just looking a little bit at the inflation experience we've had here in the United States in living memory, and then a couple of international comparisons, because I think it's good to have that perspective. And to make those international comparisons easier and better, when we look at inflation, we're going to use a standard source now, the World Bank. They produce the so-called World Development Indicators, WDI for short, where the World Bank since 1960 has tried to make consistent, comparable economic figures for almost every country on the planet. Now, there are downsides for wanting to have a world statistical endeavor like this, right? Like number one, that the numbers don't get updated as fast as elsewhere. Like here we are in 2024, and the US and everybody else's inflation numbers, they only go till 2022. See, that's still very high before it started coming back down, right? But that's okay. It can be a little slower. We want to look at history here anyway. It doesn't have as high of a frequency. These are only annual numbers. And finally, perhaps most importantly, this is depending on the cooperation of governments around the world. And different governments have very different attitudes when it comes to, how honest and transparent are we going to be when it comes to our economic data. So just keep that in the back of the mind. Like the US data, I totally trust the US data, and then I'll leave it up to you how you want to judge the other ones. So let's start out with the US inflation experience since the 1960s. And really, there's just a couple of things you want to have on your radar. So number one, we look at the 70s. Couple of big spikes in inflation here. These were the so-called oil crisis and energy crisis. We're not going to get into history or politics. I'm really bad at both. But basically, there was some stuff happening in the Middle East, and some countries that at the time were controlling the overwhelming part of the world oil markets, and even today still control a very big chunk of them, were like, we are not happy with what's going on, and we're just gonna not sell oil easily to the United States and other allied nations anymore. And then even more than now, but now it's still true, oil is just a price that goes into the prices of so many other things through transportation, or because oil is needed to make plastics or natural gas for fertilizer production, that sort of stuff. It just drove up inflation across the board. So if you talk to somebody that was sort of alive and aware in the 70s, that's going to be their framework for inflation, absolutely. And then since the early 80s, even more so since the 90s, we've just been relatively great at keeping inflation low and predictable, just like we like it. Again, target 2%. Is it always exactly 2%? No, not necessarily, but pretty decent, especially compared to some other ones we'll see in a second. And then perhaps two other episodes that are worth knowing about. We've got our Great Recession here, really bad recession, and one of the marks of a bad recession, we went into deflation here. Don't like to see that. Wasn't super bad deflation, but hey, there we are. If you're worried about Social Security benefits, don't worry. They go up with inflation. Don't get cut during deflation, so that's nice. And then, of course, what forever ruined my charts, here's the COVID lockdown, which briefly gave us high inflation. Briefly here. We're measuring this in the span of years, right? But right now in the year 2024, it seems like that's almost back under control. Not on target yet, but definitely closer to than not. If you watch this video 10 years from now, maybe I just said a silly thing and it was not under control, but it's looking pretty good from the standpoint of 2024. So that's the United States. And now let's just compare a couple different places and draw some other conclusions, a little bit of general world knowledge. So I'm going to look at another rich country here for a second, country of Japan. So on some level, similar experience in the 70s. It was less pronounced there the second time around. We won't get into it. But here's the original oil crisis also affects Japan. Very high inflation rates there, right? But really, the story of Japan that's interesting to point out is that for a variety of reasons that actually get studied a lot, Japan, for many years, since the 90s more or less, has been struggling with repeated dips into deflation. So it's the country that sort of has been having a hard time to hit the inflation target from the low end, which is a little bit unusual. Normally the problem is keeping inflation low enough, and they've had real problems keeping it high enough. Again, we won't get into the details here, but for example, the low birth rates in Japan are often associated with this, and that economic policy with a shrinking population can actually be a bit of a tricky beast. I mean, not that shrinking population is inherently a bad thing, right? Like you can also think about space and like the global capacity of our planet, but it presents a different sort of set of challenges you have to manage from a macroeconomic standpoint. Okay. So after we've looked at two relatively rich countries here, let's now also look at some fascinating episodes from developing economies. So here, first of all, is China. And what you must notice here is chart's going to start a little bit later. They've not been part of those world development indicators for since the 1960s. If you know a little bit about Chinese history, you might sort of guess why we're not going to get into it. But what you can really nicely see here is how the monetary management of this country has strikingly modernized. So in the 80s and early 90s here, we have a central bank that's still, People's Bank of China, by the way, that's still very directly under government control. And as I mentioned, because you can use high inflation as sort of an indirect taxation system, anytime you see just big direct government control over a central bank, quite often that's associated with higher rates of inflation, as we can see here, right? And then the central bank adopted a much more modern framework starting in, was it 95, I think? I'd have to look that up. But anyway, since then you can see, we've got monetary performance here that's really similar to rich countries, with inflation just really nice and contained between 0 and 5%. A little bit of craziness around the Great Recession here, but who didn't have that, am I right? You could throw in a little bit, is the data as reliable as from a rich country? Doesn't matter. It's not hugely going to be off. China, basically an example of a country that's really modernized its monetary management. Now, of course, when I say the central bank a little bit more independent, that's still within the context of a one-party system, that could change on a dime in a way that maybe in a more multi-party system it wouldn't necessarily. But still, job well done, right? And I want to start out by really highlighting some other jobs well done, because we've seen some real nice jobs well done around the developing world. So another one that I think is just such a success story here, Brazil. So first of all, check the y-axis on this thing. Inflation rates, not just like 10 or 20 or 30 or 100, like inflation rates in the thousands. Hello, hyperinflation. Brazil, definitely some inflation problems here in the 80s and early 90s. And then in 1994, just with one big bang, this problem got brought under control. Since then, inflation, of course, has fluctuated just like it has in rich countries. But when you've got an axis that goes into the thousands, everything looks like a zero compared to those early periods. But what's really interesting here is, so with a big reform of its central bank, Brazil got inflation under control. But because there was such a problem with the hyperinflation beforehand, they took an additional psychological step that can be a great move when you're confronting this problem. Along with the reforms, Brazil introduced a brand new currency, right? So it's like new label, new look, and then hopefully everybody can believe from the start that this one is going to be stable. And that was, of course, the 1994 introduction of the Brazilian real, Brazil's currency to this day. Just such a success story in international markets. Job well done. Real actually was a callback to an older Brazilian currency that had existed like 100 years ago. It in Portuguese it refers to something like royal or something like that word real. But personally, I like to think that the economists who designed it also put a little bit of an inside joke there, because when it was first introduced, it was also introduced relative to an index that was called the real value index, like in economics, nominal versus real value. And then the real was packed to this real value index. So maybe it's a little bit of the word real in there as well. I like to believe so. I don't know if anybody actually has inside knowledge on that. All right, let me show you another even more extreme move you can take if you want to get high inflation under control. So here we are looking at Ecuador. Okay, it wasn't crazy hyperinflation like Brazil, but still, like, look at the 90s here, right? And even the 80s inflation rates approaching 100%. And then also here, 2001, everything is more or less under control within modern standards. And likewise, Ecuador, part of accomplishing this was introducing a new currency, but they chose a very special version of introducing a new currency. Instead of introducing a new currency of their own, they adopted the United States dollar as their official currency. That's a process called dollarization. So that's, of course, it's got some upsides and some downsides. It makes trading easier with the United States, but now you don't have control over your monetary policy anymore, right? But it's certainly a very highly credible way of saying, hey, listen, we're not going to mess with this currency and try to derive tax revenue from inflation, because it's literally not our currency anymore. We're just going to run with the US system because they've got just super history of running on the same currency since the 18th century, and inflation just super nicely under control. And now, unfortunately, going to end on a different example here. So here we had some countries that have high inflation rates brought under control. And now perhaps a future example that I will use for hyperinflation. Hopefully a future example I'll use for hyperinflation, and then I can say, and here's how they brought it under control. Maybe even they introduced a new currency or dollarized or something like that. We are looking at Venezuela. Now, first of all, you'll notice very short time span of data here. So when it comes to participating in the World Development Indicators, we are starting in 2009. And then by 2016, we're saying, we're not reporting data anymore because the data is looking bad, right? But what you can see here is a country that already had high levels of inflation of 30% or whatever. And then starting with 2014, it just took off, went into the hundreds. That was 2016 here, so 8 years ago. And estimates by outside agencies, like, for example, the International Monetary Fund, have suggested that the rate of inflation in later years in Venezuela has gone as high as 1 million %. Is that an actual number? At those rates, how can you even measure inflation anymore? It all gets very questionable. The point is, it's almost certain that Venezuela experienced hyperinflation between 2016 and today, and it might slowly be coming back under control again. a lot going on there that makes that difficult to judge. Reliability of, like, are we going to get honest numbers from such a political system? How do you even measure things when they've been out of whack by such an amount for such a long time? The end of the story, we won't know, I think, until a few years into the future. But this is certainly the beginning of the story. Or was the beginning of the story. This was 2016, right? All right. And with that, we are concluding our module on indexation and inflation. Hopefully, at this point, you know how to adjust the dollar value using a price index, how to explain the purpose and method of indexation, how to identify costs of inflation, and how to recognize key inflation episodes in recent history. I will see you next time.